Hi, everyone. David Rose here from USXP. We are having a conversation today with a good friend of ours, Corinne from eCap Financials, and the topic is on pro forma financial statements. Now, if you are a founder in the UK or EU and you're getting ready to turn this off because you think this is for your finance team, this is for you. This topic is critical for your success in venture capital fundraising. So pay attention, take notes of this, and this step is really critical, and it's something a lot of founders overlook or underestimate. And so we want to make sure you understand what it's about, why it's important, and how to use it to your advantage. So with that, if you would, please introduce yourself, Corinne, and tell us where you are in the world today.
Awesome. Thank you so much, David. So I am in North London today. So hi, everyone. Thanks for tuning in. My name is Corinne Thompson. I'm the CEO and founder of eCap Financial. We provide fractional CFO services for companies who are fundraising. So what that means is we build financial models, investor decks, data room, market sizing, valuation analysis, like any of the collateral basically required to go out and fundraise. We also work with companies through that fundraising process as well, so we can project manage rounds for them and provide kind of like advisory guidance and support through the fundraising process. We also do financial due diligence for investors. So we write red flag reports when they're looking to invest in companies. And it's anywhere from investors who invest a couple of million into a company through to kind of like larger tickets, 50 million plus check sizes going in. So we see both sides of the equation and we see both sides of the coin. And so we see a lot on the investor side in terms of what they're really looking for and how that then translates in the funding market when companies are going out to raise. So yeah, super excited for this topic in this conversation, David.
Well, I think that unique view you have because you do both due diligence preparation and pro forma models and all those sort of things for startups, but you also are part of the financial diligence team for VC. So you're going to be reviewing these same kind of things and reporting back to the VC. So I think that really gives you such a powerful and unique view on this topic. And I'm really pleased we're able to talk about it today. Give us some background. Like, how did you get into this position where you're doing both of these things? So they typically seem like separate skill sets. How did this happen?
Yeah, sure. I guess they are very separate skill sets, but they actually marry up a lot of the historic experience I have. So I started my career at KPMG and I started in audit. Essentially financial due diligence is a form of or a subset of like audit. It's reviewing historical information. But then after KPMG, I moved in house and I've worked in the tech space now for like nearly the last 15 years, but I worked in mainly kind of commercial finance director roles focusing on fundraising and M&A. And when I left KPMG, I was clueless on this stuff, but I worked for some incredible CEOs who have managed to kind of bridge that sort of transatlantic piece, who have raised, significant amounts of capital, who've done a lot of M&A themselves. And I was lucky enough to be on the journey of those companies. And so when I founded eCap in 2023, it kind of the sort of two skill sets kind of naturally led into new business and into work, but then they sort of fed off each other as well.
And what is the state of the typical financial model when you're either going to work for a startup or you're doing due diligence on a city? What's the typical state of that quote unquote financial model or pro forma the first time you put eyes on it in most cases?
Yeah, I mean, it tends to be relatively terrible. And so we often get people come to us and they say, um, you don't need to build a financial model for our round. We've got one. Maybe you can just take that and amend it. And honestly, David, it's far more work to amend someone else's model than it is just to build a model from scratch. And when I say it's terrible, like again, when I left KPMG, like I couldn't build financial models. I never built a financial model before. And so I think uh, there's a lot of misinformation about what they should include and shouldn't include, and there's a lot of these like templates out there which are very binary and sometimes very difficult to follow. But when I say terrible, what I mean is like just some basic kind of like hygiene, but then also like a lack of understanding of what you're looking to do with that financial model. So from a hygiene perspective, keeping it as simple as possible. You should have no more than like 6, 7 tabs maximum, right? You do need to have 3 statements, a P&L, a balance sheet, a cash flow statement. And the formulas should be super clear in terms of how they link. Having also like a summary tab as well, where everything's sort of like annualized up from like a monthly basis, and having a very clear view of like top line growth, what you expect from like an EBITDA perspective, like headcount in the business, some of the key kind of like SaaS metrics is critical. And then the other thing I see is just having a tab of assumptions. Like, do not put assumptions on every single tab in the model. It's like one tab, all your assumptions listed there. And that's what basically drives the kind of basis of the model. And then what I really like that goes alongside that is I normally film like a Loom video over the top where I'm basically like sharing my screen and talking through how the financial model is built from like a bottom up perspective. So there's the hygiene factor, but then there's also like, what are we using this model for? If it is an internal operating model, have it as messy as you want. It's your model. It's how you run the business. Like, do what you want with it. If we are going external with this and we're showing this to investors, it just needs to show some very kind of clear views. So like that summary view, P&L, a couple of lines from the cash flow statement, your cash balance as at year end, like growth rates, again, depends on where you're raising investment from, but having like the clear era growth rates on there, your gross profit margins, again, making sure that they're tailored for the audience of what they would expect those gross profit margins to be. And then also grouping things. So like, a good pro forma, like VC fundraising model, and we tend to work in the space of like venture capital more than any other space, needs to demonstrate things by like grouping. So sales and marketing, R&D, G&A, not what you export from Zero, which tends to be like salaries and wages, accounting costs, legal and professional, bank charges, or whatever the chart of accounts is in Zero. And so I would say those are kind of like 2 things. There's like a hygiene piece, and then there's also like tailoring it for your audience.
In my experience as a founder, raising venture capital, I always think about it as a 3-step process when you're kind of going through the motions with a potential investor. The first one is going to be a screening call just to see if your firm fits their investment thesis, and are you kind of a founder kind of personality where they might be able to work with you. That's kind of step 1. Step 2 is a little bit about product. Maybe there's going to be a demo. There's going to be some discussions and some in-depth discussions around product. And then almost always step 3 is, can we see your pro forma model? And I think that's where a lot of startup founders fall down, because what they don't understand is just how critical that model is, because it's really your operating plan. It is your business plan. It has every assumption about the business in it, about your revenue, your headcount, your metrics. And so I think a lot of firms, and I think this is more so the case in UK and Europe than the US, because it's better well understood, is in that cadence you have the first meeting, things go well, they like the story, they like the founder, they like the product. And when they ask for the pro forma, when people are often giving them basically a rough P&L or a budget. And can you kind of break down what's the difference between a P&L or a budget and a full pro forma model? What's actually included? Let's just talk about the basics there.
Yeah, sure. So a budget tends to be something that a company will compile for like the next 12 months that's been signed off by the board, that is an operational plan. And it tends to have a load of detail in it. And when I say a load of detail in it, it's got like, elements related to team costs, for instance, a real breakdown on like a lot of detail around like travel, or like a real breakdown in terms of like a lot of detail around like marketing. It tends to be very granular, but it's the day to day. How are you running your business, and what are we doing to make sure we hit those numbers on a monthly basis from a budget perspective? Like a model that goes to investors is a lot more summarized. It's a lot more top down to a certain degree, but it has clear forward looking assumptions. Where are we going as a company? Whereas a budget tends to be like, what's happening over the next 12 months? So it's still a where are we going? But the financial model for investors is a lot more like, in the 5-year time horizon, that 3 to 5 years, with capital coming into the business, What are we looking to achieve? What milestones do we need to hit? Who do we need to have in place to get us there? And I'd say it's a lot more like broad brushstrokes versus this kind of like 12-month. Whenever I think budget, I think just more like in the weeds. And that's not what you want to be presenting to an investor.
Yeah, for sure, for sure. Um, I guess one of the questions about um, revenue assumptions. So I think in the U.S., I mean, you can kind of picture the revenue assumptions are going to be this, right? They're going to be we're going to do $100 million in ARR in 3 years. I
Yeah.
think our friends in the UK and Europe are typically more conservative than that, and
Yeah.
they're I think part of the reason is I think there's a much more emphasis on profitability in Europe than the U.S. Where in the U.S. it's really on growth. So what would be the expectation that reasonable? What advice would you give a founder who's putting together a pro forma who wants to give this to a U.S. investor about what should that revenue ramp look like? What is the line between realistic and optimistic versus what's kind of expected in the market? Can you kind of talk about the revenue ramp from your perspective?
Yeah, sure. So I'm just going to open Harry Stebbings, who I'm sure we all know from the 20 VC fame, but also just all the work he's done in VC, which is phenomenal. He did a really good LinkedIn post recently where he was like, founders are not aware of what VCs expect growth rate wise in 2026. What you should expect if you are 5 million to 15 million ARR with these growth rates. 300% year on year, swell, you'll have your pick of investors. 200% year on year will be good, likely tier twos. Quality of revenue is important in whether tier one or tier two. 100% year on year, this will be hard unless insanely high quality revenue. Expect pain. 80% or below, cut burn, get profitable, lean on existing, expect no net new. This is the state of venture today. And I think that's a brilliant post, if I'm honest. And I think if you're going to a US investor, bear in mind, a lot of people say, we're expanding to the US and we want US VC funding. Like US investors have their pick within very, very big borders as to who they can invest in. Like, why would they invest in a UK European company expanding to the US? You need to show those growth rates, and you need to show them from a historic perspective, but then also forecast it going forward as well.
One of the things I learned as a founder on the financial side is there's a lot of duality, and you get beat up on different assumptions.
Mm.
And one I found consistently was you want to show you're typically when you raise around the expectation, especially from US VCs, is you're going to deploy that capital fully in 18 to
Mm-hmm.
24 months. And so you're going to want to show pretty significant growth rate during that time.
Yeah.
But one of the things that I found myself getting beat up on both sides is, okay, well, you have to show this tremendous growth rate. But what happens if you can't raise your next round when you run out of that cash, that 24-month mark? And then they beat you up. Well, how are you going to survive if you can't do that? And so one of the things I learned to do in my performa models is I would model my growth over 24 months to be 2 headcounts shy of profitability, because US investors hate profitability, just so you know, in the models. They want
Yeah.
growth. But what I would do is I would make my cash work just right. So at the 24 months, I'd be 2 headcount away from profitability. So I would never show profitability, but I would also get these questions. Well, what's going to happen if you can't raise? And so I would fire these 2 people, and then we'd be break even. And so, like, how do you advise founders to think about profitability? Because in Europe, that's a big thing, and you hear that early on. I have seed stage companies, bragging about their profitability. I'm like, don't ever say that to US VCs. How do you advise founders to think about profitability in general when talking to US VCs, and then how do you model it typically?
Yeah, sure. So I completely agree with you. US VCs do not want to see profitability, whereas any financial model that we build um, for more of a company that's focused on like a European fundraise, we do this round of funding and then we get profitable. Like we do it basically with every company that we work with. But from a US perspective, we don't show us getting profitable. I like what you've done there. What I would say is twofold in the models that we build. One is basically a narrative, and one is like baked into the model. So the one that's baked into the model is like, what are the milestones that we are hitting that demonstrate we're on track for those revenue projections. So what are the leading indicators? And thus, if we're not hitting those leading indicators, where in the model can we potentially reduce cash burn in order to hit profitability? So like being very kind of clear of like what success factors, what they look like as we're kind of like building that out. And you might be thinking, well, what is that? But like pipeline, right? Like you have to have pipeline coverage in order to hit those growth rates. So if you suddenly see in a quarter or a couple of quarters that like pipeline is slowing up, you need to then potentially take steps, and you don't know like how to make that pipeline speed up in terms of like adding new deals to the top of the funnel. You need to take steps, I'd say now, basically to then like preserve capital while you work that bit out to then go back out and try and keep the kind of like momentum top line train going. The other bit, which is a lot more, I'd say, like not baked into the model per se, but definitely is a narrative that I work alongside it, is like normally at the point that you raise equity fundraising, venture debt gets very easy, or not very easy, but it gets easier, right? So like having a back pocket capital facility so that, if shit meets fan, and excuse my language, but like if that happens, then basically there is a way that you can then keep funding the business, and you can like turn things around, make headcount changes, like whatever it might be, right? But like you've got that runway there.
I remember as a founder, I took these models super seriously because I knew how important they were in the VC fundraising process.
Yeah.
And I would really agonize over every line item detail, like 3 or 4 years out, like trying to make sure that all the metrics are met and the headcount's right and the revenue's right. And I used to really, really, worry over that too much, honestly. And I finally had one investor say to me, like, look, David, we know every single one of your assumptions 3 years from now, every single one of them are wrong. What we really are looking for here is do you understand the business? Are you able to think it through? Do the unit economics work? Do your cogs go down over time? We basically want to see, are you really thinking about the business? But we all know, because we're all former operators, we all know every assumption you have for 3 years from now, every single one of them are wrong. We just want to see, can you put together a rational, reasonable model where you really understand and think about the business? Do you see the same thing?
For sure. I mean, like, at the end of the day, you're under a lot of pressure as a founder, particularly if you take venture funding. As soon as you step on that, escalator, you've got to perform and you've got to hit milestones, and it is a lot of pressure. And so they're not wrong. Like you're not going to hit those, but they want to see a founder with a good quality of thinking, and they want to see a founder who, like, if something does go wrong, can get themselves out of that mess, can get themselves out of that problem ASAP. And so, a lot of the times they're investing in the total addressable market because it's a big market and there's a lot to be consumed, but they're also investing in the team. Can you execute? Can you figure things out when things go wrong? And that I think that is actually like where it lies. They know these models are not, you can look at those numbers in 3 years.
They're not gospel. You're not going to be held to account
Exactly.
3 years from now if your CAC is wrong.
100%.
Right. And let's talk about metrics, because I've been doing this a long time. So I remember when like the initial kind of pro forma models, there'd be an income statement and balance sheet and cash flow and kind of assumptions page. But over time, these traditional SaaS metrics started getting included and built into the models, because investors wanted to see like the traditional things like your cost of customer acquisition, your long-term value, your average contract value, your churn rate. And so you started building all these metrics into it. I think this is all very, very B2B SaaS oriented metrics that I think most people who are around this space have all heard about or are aware of. I was just kind of curious, as AI proliferates, right? And I think there's a lot of people who are questioning the future of B2B SaaS software in general. We'll see how that plays out. I'm not convinced they're all going to go away tomorrow, but I guess I was kind of curious, like, how do the metrics change? So if you're in the AI business where you're in the agentic world, you're not necessarily thinking about your CAC to LTV in traditional senses. As AI is kind of taking over the world in all these startups, how do the metrics change in the new agentic world versus the traditional SaaS world when you're building a financial model?
Yeah, that's a really good question. And just to sort of say one thing on AI is that like not everybody has to be an AI company, right? But my experience and
Doesn't
the
sound
questions
that way.
I've
It sounds like everybody has to be that way from the outside.
well, yeah, but the questions that I've seen asked, which I think are valid questions in a fundraising process, are how are you adopting AI internally for efficiencies? But then also, is AI ever going to come for your business? Right. And that's the threat for a lot of companies is like, or people's jobs is like, what's the AI capabilities against your current market and what you're doing and who you're competing against. And so I'd say, often when we speak to companies, there's this great desire to talk about how like they'll become an AI company and they have AI products and AI modules. And it's like, it's not always necessary, but it's a case of like, how are you adopting it internally for efficiency? But then also as well, like, how are you safeguarding your business against AI? And so yeah, and then with regards to like AI companies, we have actually built a couple of financial models for AI companies. Although, slight sort of like side note, as you and I discussed before we came on this call, AI now builds very good models for AI companies as well. And I think you and I both discussed Claude. Claude has come out with some pretty stunning products of late. But anyway, sorry, I digress. In terms of SaaS metrics, like what I still see at the moment is like core SaaS metrics are things like your NRR, so your net retention revenue, right? And you want it to be like best in class was 130%. Like you want it to be that at least plus, because then you're not hiring reams of sales teams to bring in like new revenue. We're driving a lot of expansion. We're driving a lot of like upsell. There's a lot of like organic growth basically within your kind of like customer database rather than it just being like direct sales that's generating like new ARR. Another one that I still see that gets a lot of scrutiny, this is more in the UK than it is in the US, is Rule of 40. Like, what is your capital efficiency in terms of like burn? And I would say, even some US investors care about this. Like, it's all very well spending, but like, what's the top line that you've delivered against that? And I think Rule of 40 still gives a very good view of that. To the ARR, to the AI efficiency one, sorry, ARR per FTE. I see that one a lot. We work with quite a few like investment banks as well, and often when they're doing like their market analysis on like what's happening in certain industries, like ARR per FD still gets a lot of scrutiny. So yeah, like there's those ones I would say are the ones that are still key.
Let's kind of flip to the other side of your brain for just a second, right? Because we've been talking about kind of the founder view of like what needs to be done. Let's talk about the VC view. So when
Mm,
you're helping to do due diligence on a potential investment for a VC firm, and the company's financial model comes part of the cycle probably before due diligence. This is pretty early in the process. What is it that the VC, you, the analyst, whoever's reviewing this on behalf of the VC, what are they initially looking for when they first open the model?
yeah. So presentation matters a lot because when I open up a model, the last thing I want to see is 25 tabs and me sat there being like, gosh, where do I even begin on this? And that is like, and it subconsciously ties into like the what is this finance team like? Who has built this model? Like, what is the quality of thinking that's gone into this? Is this structured? Like, and you start to ask these like subconscious questions, basically of it. And so I would say it's not a conscious thing, because obviously like I want to get into the assumptions and the meat of the model, but it definitely like helps to kind of like frame things. And then once I get into the model, it's like, all right, what are we saying are the assumptions here that are going to drive the growth, and what have they been to date? So like from a top line perspective, like what is the business model? So what is the ACV? How many salespeople have we had historically? What have their quotas been? What have their attainment levels been? What has that ACV number been? And then looking at it from like a forward looking perspective to be like, how how much uplift have we given that suddenly will be, we've learned our lessons from hiring salespeople, and now we can do it a lot more efficiently now, and we know the kind of like caliber of person we're sourcing for. I get these arguments and I get these pieces, but like, how much of a step up are we looking at here? Also, as well, like I would say, within that kind of looking at your ARR waterfalls in terms of like new, we've just covered there, but like, what is upsell, what's expansion, what's downsell, what's churn, and just again making sure that like there's a narrative that supports why we suddenly think from like an upsell perspective or an expansion perspective we're suddenly going to go from like 5% last year to like 30% this year, right? And so again, like working through some of these like key, and I always start with the top line assumptions, and then if I'm honest, if I have access to the full data room, I'll then start sifting around the pipeline and understanding like how much pipeline do we have to support what we're saying from like a top line revenue perspective. And I'm talking very much like B2B enterprise SaaS here. This is not like self-serve sign up type pieces. For those, I look at more things like your marketing spend and your CAC, and what we've realized from that marketing spend historically to then like drive like performance basically going forward. So that's always my starting point. And then what I really care about as well is digging into some of the metrics. So like gross profit margin, i.e. like what is the unit economics of this business? Like how scalable really is this? And particularly we do quite a bit in like infrastructure hardware as well, because I think SaaS and AI, they've had a lot of like love the last couple of years. I do think the next big area that's going to get that kind of love is AI coupled with infrastructure, so robotics basically, or like some kind of like AI data layer inputting into some kind of like infrastructure. And so we're seeing a lot more of that. So like, how scalable is the hardware? How scalable is the tech that goes alongside it? What is the working capital consumption of this business? And then like going through basically from like sometimes people are quite light on costs of what they think it'll take them to get from like A to B. And again, just understanding like, what team are we hiring? What costs are we going to be incurring? And just to get a well-rounded view of like what has happened and what do we think the state of play will be going forward. And I sort of like the icing on the cake is also very much like just opening up the deck, because I always start with the model just because I'm more of like a numbers person, and then I'll go to my deck afterwards and be like, what story are you telling me? What vision are you painting here? Like what space are we operating against? Like who are we really competing with? Like what partnerships do we have? Just to then really kind of like, I don't know, test that financial model.
Well, I know we're going to have, it's a really big topic in itself. We're going to have a separate discussion on data rooms and the due diligence
Yeah,
process, because that is
we
a
are.
ginormous topic in of its own.
Yeah.
When you start looking at reviewing models for VC firms, what are the red flags that instantly kill a deal? The first time the model comes in, what just stops the deal cold that you've seen?
Um. So, like, I know things from a DD perspective. And we don't ever say don't do this deal. We just give feedback points, and those feedback points get taken in light of many different like components as to whether like a company goes ahead, or a VC goes ahead with the company or not. And so I'd say for the earlier stage companies, it is revenue growth. So we did FDD recently where the company had gone from 0 to 5 million in 18 months. And like it, fast growth, right? The cash collection was pretty ropey, if I'm honest. They definitely were collecting cash, but like it was a pretty shoddy process. There was some bad debt in there. There was just a bunch of stuff where, like, as a finance person, sort of like it hurts my soul somewhat. But at the same time, the investor was like, we don't care. That can be fixed, right? Like that can have a process put in place. 0 to 5 million in 18 months is phenomenal. And we know the line grab that these guys are going after. So like, let's not, worry too much about the cash element there. Where I have seen investors pull out is where like there is actually it tends to be around tax, where people just haven't done the proper tax planning or thinking around that. So like deferred tax liabilities. So like liabilities basically coming up in the company, which are fairly catastrophic is the wrong word because these things can always be fixed, but like will have a big impact in order to try and like unpick and basically kind of like sort out. From a financial model perspective, we do quite a bit of sensitivity analysis over the numbers. So again, we don't ever say we would invest, we wouldn't invest, but we do show to investors, right, if you were to reduce certain components of the revenue by these percentages, this is the impact it has on runway. Or like I mentioned, the hardware pieces, like how scalable or how realistic are those like unit economics? Like digging in terms of like, well, how much are you paying for these components from China? What is the risk from like a shipping and logistics perspective of getting these things over? And again, we just flag them as red flags that we see. We don't ever say, this is right or wrong. We often get models, like sometimes when investors are reinvesting in a company rather than it being a fresh investment, that's when we really get the stress testing models. So they'll say, here's a model, like, and these guys have told us this money will get us to profitability. So let's take a European investor. Can you stress test that for us? Like, how accurate is that? Or this model will get them to an exit, and they think based on their conversations to exit, they need X amount in ARR. Like, will this money get them to X amount in ARR? The other area that we also do a lot of like reviewing assumptions of models, just for listeners that may be more in the kind of like biomedical space, pharmaceuticals, deep tech, where it's like it's a longer ramp up time to commerciality. They'll then be like, actually, what they care about more and what tends to be more of a red flag is like, if we take a deal we did recently where that lead investor was putting in a 40 million check, and there was like, the round was coming in at about like just shy of 100 million overall. And it was like a pharma company where like there was a lot of IP, there was a lot of patents, but it was like there's some big costs they're going to be incurring in that budget. It's like, all right, can you just check out those costs? Can you check the supplier contracts? Can you tie these things back to invoices? Like, can you just validate that we're not suddenly going to invest in this company and, I don't know, 3 months down the line be like, wow, the costs are actually like 2x more than what we were anticipating in order to get us to profitability. Or actually the grants they said they've got haven't come in, or their milestones they're not going to hit. So like it's very different flavors for a different type of investor. But like, yeah, that tends to be the sort of the shape of it.
Talk about timeframes. I know, like I can think of very specifically in my past where, I have an MBA. I can build a model. This is no big deal. I'm a smart guy, and
Yeah.
you said kind of go through that process where you have the initial meeting, you have the product meeting, and they're like, hey, can you see your model? And you send it to, and you immediately get feedback. Hey, this is not good enough. This is not work. You have to give a proper model.
Yeah.
How long does it take if a founder comes to you who has that same experience? He's got who's got the feedback. Hey, what you've built is shit, and this isn't going to work.
Yeah.
I need professional help. I get it now. And they come to you like, but they're going to have their super high sense of urgency because in the middle of the deal right now. They come to you and say, hey,
Yeah.
Corinne, really need your help. Can you build us a pro forma model for, that's going to meet all those requirements this week? How long does it typically take? What are the expectation settings from someone's going from almost nothing to I need something that's VC ready? How long does that take?
Yeah. I mean, if they use us, we can turn it around in a week, right?
Wow.
Like it's
Really?
yeah. And when I say if they use us, like we get 100% dedicated on it. We get all the material, because sometimes this is also an issue, right? And we see this in FDD. Like we put information requests forward, and we don't put them forward for fun, right? Like we put them forward because we need that data in order to be able to like turn things around. We can, and as long as we have all of that and we have access to founders and to finance team and to like sales team, we can turn that around in the space of a week. It's
Wow.
tight. It's very, very tight, but like that will get you something that at least we can then iterate on, right?
Wow, that's really impressive. I would think it would take them much longer than that. That's great news. Of course, we're USXP, US Expansion Partners. We think about a lot about the US. And so I had, I guess, a couple of questions. One is when you build a model and someone's wanting to raise in the US, do you build it in GBP or USD, or do you build both, or is there a conversion metric? How do you? I've never done that because everything I've done is a little simpler, right? It's in the US, raising from US funds, it's all US dollars. How do you
Yeah.
approach that from the UK or Europe?
Yeah, so we always take the actuals in sterling because that's what gets spat out of Zero, for instance, or QuickBooks, right? And then we'll put the currency conversions in and we'll do all the forecasting in dollars. Like American funds, they want to see a US model, right? They don't want to see some kind of like where they're trying to like work out what the sterling amounts are. But like when we put the actuals in, we convert them all into dollars. So then that summary pro forma at the beginning, tab one, basically has the historics in dollars and the forecast basically in dollars going forward. And so that I think is, yeah, I think that's critical if you're raising in the US.
One of the things we see regularly is, and you and I have talked about this before, is when we look at financial models for companies. Wow, we're always like, you talk about hurts your heart. It hurts my heart when I see the U.S. Part of the P&L. In fact,
Yeah.
I looked at a client's forecast last week, and they basically had their salary amounts, which they estimated in the U.S., which were all wrong, and then for everything else, they just had a overhead 23% is that was their entire calculation for U.S. expenses.
Yeah.
Which in the U.S. it varies by market. It's much more much more complex than that. What is it you typically see when companies are having a U.S. expansion? They have something separate. What do the VCs expect? So if a company is raising with the expectation we're going to raise and we're going to go to the U.S., what should be the expectation of what the model shows around those details?
Yeah. And you and I have spoken at length on this. Again, it's about having well thought out assumptions. Just putting one line in your assumptions tab, which says US expansion and attributing, say, like 1 million per year, doesn't demonstrate that you've actually like given proper consideration as to what that expansion looks like. And I know, David, when you work with companies, it's like, what state are you going to expand into? Like, who is going over? Is it the founder? Like, who from the team will be like out there? And therefore, based on that, then who are you hiring for around that? Like, what do we need in terms of like travel expenses, for instance? Because the US is massive, and I know, there's a lot more travel that happens in the USA versus the UK. And I think sometimes I say UK, I mean Europe, we can just be a little bit naive as to like what it actually costs to do business in the US. It's a massive market. Yeah, like you and I both know, there's a huge TAM there, but it takes a lot of capital to get there. And I think, properly modeling out, you know, health insurance. We don't have that in the UK. I mean, we might have that soon, but like health insurance in the US, like it's a big amount. Like RSU structures, they cost money to put in place, right? Pension, it's like, this is a kind of almost, not almost, it's a given, right? Like the benefits package you're giving someone there versus the benefits package you're giving someone across Europe is substantially different. And yeah, it may come with a different expectation, but I also think as well, like the US is, it's quite funny because I find the US is very transactional basis, but I actually think from a sales perspective, particularly for enterprise sales, it's very relationship basis, and it's very like who's got what Rolodex and how much is it going to cost to unlock that Rolodex, and so like you're talking, and what I mean by that is you're just talking longer lead times to seeing your sales team ramp up versus maybe, here in the UK where it's a little bit more like it's just easier to access certain people, or like it's a smaller market. There's just certain dynamics at play. So, sorry, in summary, I really want to see a financial model that has the granularity of thinking around what, and it could be US expansion. It could be the expansion into Asia, into Japan, into Singapore. Like it doesn't really matter what expansion. Or like, in the UK, there's a lot of like subsidies for like, we've got this thing of the Northern Powerhouse, right? Like setting up like manufacturing capabilities in the north of England, right? Just doing one line for it, again, same thing, doesn't work, right? Like who are you putting there? What are you putting there? Where are you setting up? Why are you setting up? Like proper thinking behind this.
And I guess one kind of question as we wrap up here. This has been a really great conversation. Thanks again. You know, if you had met a founder that you really liked and admired, and thought they were brilliant and hardworking and had a great idea, and they're getting ready to start the venture fundraising process. What is the advice you give them in your role as they're thinking about putting together a pro forma model? What advice do you have for those people?
Yeah, sure. And it's kind of where we start all of our engagement. So like here are some like free things that we normally do, but like workshop it out, right? Like what have we achieved to date? What are we looking to achieve? And get the key people in the room who are going to be part of this fundraising journey, right? Like what milestones do we want to hit? And therefore what capital do we need to raise in order to hit those milestones? What has worked well for us? What are the opportunities for us? What hasn't worked well for us? What are the threats to our existence and our being? Like, who are we competing against? And what I often see happen is that, like, you know, you kind of need to whiteboard this out. You need to get this all out of people's brains and onto a whiteboard and get everybody kind of like aligned with that before you ever put pen to paper on a model or on a deck. Because these two artifacts, they're just the outcome of a well thought through plan and strategy of what you want to do for your business. And don't get me wrong, in 6 months' time, you might have a different strategy because new information comes to light. But like, you got to have that initial starting point before you then put that into a set of numbers or put that into a narrative and drape a story around it, like you see in a deck. And I think sometimes that quality of thinking is just, it's lacking, and it's kind of like, what's our vision? Like, what's the big hairy problem or goal that we're looking to achieve? And then like, what of that do we want to achieve? And like, particularly for the US, let's just be all out ambitious here, right? Like, this is our shot at it. And again, like I said at the beginning, like running a company like this is super, super stressful, right? So like, if you're gonna go shoot for the moon, like at least have the excitement and joy of like, what does that moon look like? And like, how do we get there? Rather than just like instantly going straight into the numbers. And I say this because, I struggle with this sometimes because that's my happy place in an Excel workbook. But like, you kind of need to do the brain power before that, and bring in external parties that, I'm not just plugging myself here, but like yourself or like lawyers, transatlantic lawyers that, you and I both work with that are very good, and just be like, flesh the plan out with them, have a third party to come in and really like beat the plan and be like, where's the watertight bits, where has it got skeletons, and like, what could the Q&A look like for investors, and just start to like solidify that before we start putting numbers down on a piece of paper.
Corinne, this is really great. I mean, I think there's a lot of information out for entrepreneurs who are going down this journey about, how to pitch your company, how to talk about your TAM, how to talk about your team, all those sort of things. And I think there's even a fair amount of information out about how to, position your product and talk about IP and moats and those sort of things. I think there's a real gap when it comes to this third really important step of, we need to see your pro forma financial model. So thanks for having this conversation. I think it's really critical for founders to understand these details and just how important this step is in the fundraising. It's not just a finance operations exercise. This is how you position your entire company, your thoughts about the company, your strategy about the company. And it's really a really critical step. So thanks for sharing your insights on this. And our hope is, of course, that more founders will find this useful and hopefully set them up for success in their own fundraising journey.
Yeah, and just one final thing, sorry, David, just to say, like, use experts, like, in experts, right? Experts who have actually physically done it. So, like you, David, you've expanded in the US, you've grown companies in the US, like you know what it takes to make it in the US, right? Like, I've sat as the CFO of companies fundraising. Like, I know what it takes to get beaten up by investors and have to constantly like, come out and do the show. I know what materials are required. And I'd say, for whatever geography you're expanding into, or for whatever you're looking to do, just find the people who have done it before. Don't find the people who proclaim that they can advise when like they've not done it. And so I just want to end with that, because I see a lot of money being wasted into avenues of people getting other people's hopes up, when actually those people haven't physically done the practical elements of it before. So anyway, that's just a small side note.
Great advice. Thanks again, Corinne. We're going to have another discussion on due diligence and data rooms. So thanks everyone for joining us, and watch for our next discussion coming soon. Thanks for watching, and have a great day.